Welcome to Breaking News to Trading Moves. We're looking at a market event that just established a very rigid standard for how companies are valued right now. GMR Solutions, which is a massive ambulance and emergency medical services provider backed by the private equity firm KKR, well, they just went public.
Right. They listed on the New York Stock Exchange under the ticker symbol GMRS.
Yeah, and the numbers here tell a very specific story. So they raised $479 million by selling 31.9 million shares. They priced those shares at $15 each. But here's the detail we are focusing on today. They originally targeted a price of $22 to $25 per share. I mean, they took a rather large haircut to get this deal done.
It is a stark message from buyers, honestly. Dropping from a potential high of $25 down to $15 tells us that the capital is available. Like, the public markets are open for business, but investors are demanding an exact price.
Right, they want a bargain.
Exactly. They are no longer willing to overlook structural financial flaws just to get a piece of a recognizable brand.
So we need to figure out why investors drew such a hard line in the sand at $15. And what this pricing tells us about the broader demands in healthcare and private equity right now, because the data points to a demand for safety over size.
Yeah, investors are perfectly willing to fund healthcare infrastructure, but they scrutinized three specific things GMR brought to the table: heavy debt, modest growth, and reimbursement exposure.
Let's start with that heavy debt.
Right, so those three factors combined are a recipe for investor hesitation in the current environment. We really have to look at how they interact. Heavy debt means a large portion of a company's operating cash goes directly to paying interest.
It does not go toward fueling expansion.
Exactly, and it does not return value to shareholders. When borrowing costs remain elevated, well, debt acts as an anchor on the entire operation.
And that leads into the second factor, which is modest growth. I mean, if you are carrying a massive debt load, you ideally want your revenue growing so fast that the debt becomes a smaller percentage of your overall picture.
But GMR is not rapidly expanding.
Right, they're growing, but slowly.
Yeah, you cannot outgrow an interest burden if your top-line revenue is only creeping upward. Investors run the math on that and immediately calculate a higher risk profile.
Because any minor operational stumble could jeopardize the company's ability to service that debt.
Precisely. And then we have the third factor, which is unique to this sector: reimbursement exposure. When a paramedic drops a patient at the emergency room, the patient does not hand over a credit card to pay for the ambulance ride.
Right. I mean, the ambulance company relies on insurance providers and government programs like Medicare and Medicaid to actually collect their revenue.
Which introduces a whole layer of political and corporate unpredictability into their cash flow. If a government agency decides to lower Medicare reimbursement rates to balance a budget, the ambulance company takes an unmitigated hit to their revenue.
Or if private insurance companies make the billing and collection process more adversarial.
Yeah.
Or start denying more claims.
Right. The time it takes for GMR to actually get cash in the bank stretches out.
So think about this like buying a house in a sought-after neighborhood. You know, the market is active and buyers want to live there. But they walk into this specific house, they look right past the fresh coat of paint, and they inspect the plumbing. They check the roof.
Oh, I see where you're going with this.
Yeah, those structural issues represent the heavy debt and the slow growth. The buyers say, well, we will purchase the property, but we are demanding a steep discount because we had to take on the financial risk of these repairs.
Right. They refuse to pay a premium price for a fixer-upper, even if it is the largest house on the block.
Exactly.
The real estate analogy captures the mechanics perfectly. 5 years ago, in a different financial climate, a company with GMR's sheer scale in the emergency transport space might have commanded a top-tier price.
They would have just bought the biggest house.
Yeah, investors would have bought into the market share and worried about the debt servicing later. But today, buyers meticulously scrutinize balance sheets. They demand predictable cash flow and clean financials above everything else.
Well, because the buyers demanded that lower price, and because the sellers accepted it, the deal actually crossed the finish line. The house got sold.
A transaction occurred.
Right, and despite the discount, that successful listing creates a specific set of winners in the market. Let's look at who benefits from this IPO actually happening, starting with Wall Street itself.
Okay, so the data highlights institutions like JPMorgan Chase, ticker JPM, and Bank of America, ticker BAC.
Because the capital markets desks at those major banks generate their revenue on volume and activity.
Yeah, they are the underwriters. When a company wants to go public, they hire banks to manage the process, gauge demand, and actually distribute the shares. The banks collect underwriting fees based on the capital raised.
Even with GMR pricing at the low end or far below the anticipated range, $479 million still changed hands.
And the banks collect their percentage of that total.
So they get paid for facilitating the transaction, regardless of whether the seller achieved their dream valuation.
Right, and that is just the immediate payout. A completed deal opens the door for follow-on financing opportunities. Once GMR is a public company, they might need to issue bonds to restructure their debt, or they might do a secondary stock offering later on.
Meaning the banks that handle the IPO are now in a prime position to earn advisory fees on all those future maneuvers.
Exactly. Furthermore, activity breeds more activity. If other private companies see that deals can get done and they decide to accept realistic valuations, the banks see better deal flow across the board.
Okay, so the banks make total sense, but the data points to another group of winners, the alternative asset managers, specifically the private equity firms.
Right. We are talking about companies like KKR, ticker KKR, and Apollo Global Management, ticker APO.
Now, I have to stop right there. KKR was the sponsor for GMR. They aimed for up to $25 a share and settled for $15. They left hundreds of millions of dollars on the table.
Yeah, they did.
So wait, how can we call the private equity firm a winner in a scenario where they took a massive pricing hit?
Well, you have to look at the underlying mechanics of how private equity funds operate to see the win here. Private equity firms raise capital from outside investors.
The limited partners.
Right. These are pension funds, university endowments, wealthy individuals. The private equity firm uses that capital to acquire companies, improve their operations over a specific holding period, and then sell them. They must return an actual profit to those limited partners.
They have a mandate to return capital. I mean, they are not designed to hold these operating companies forever.
Exactly. And the problem over the last couple of years is that the exit window has been severely restricted. Private equity firms have been sitting on aging investments, unable to secure the high valuations they wanted in the public markets.
Oh, I see.
Yeah, by accepting a much lower valuation for GMR, KKR proved to their limited partners that the exit window is not completely sealed shut.
So it is about proving liquidity is possible, rather than maximizing the price on every single asset.
Yes. A completed exit at a lower valuation is often far better than holding a frozen asset indefinitely. It provides immediate liquidity.
Wow, okay.
It allows KKR to return tangible cash to their investors, rather than just pointing to a theoretical paper valuation on a quarterly statement.
Right, because when a private equity firm goes out to raise their next multi-billion-dollar fund, they need to show a track record of successful exits.
Getting a major portfolio company like GMR out the door, even at $15, clears the backlog and keeps their investment cycle moving forward.
It is like deciding to hold a garage sale. You might accept $50 for a piece of furniture you thought was worth $200, but you clear out the physical space, you put actual cash in your pocket, and you move on to your next project.
That is a great way to look at it. Clearing that backlog is essential for the health of the entire private equity ecosystem. They need the capital flowing back to the limited partners so those partners can reinvest in the next fund.
Got it. Now, there's a third group of winners we need to cover, the emergency care infrastructure suppliers. Because GMR relies on physical, tangible assets. They operate ground ambulances and helicopters.
Right, so companies like Ford, ticker F, and Textron, ticker TXT, are intrinsically linked to this listing. The physical reality of emergency medical transport is highly capital intensive.
Yeah, those vehicles take a beating.
Ground ambulances rack up miles quickly and break down. Air medical services require rigorous, constant, expensive maintenance.
And by accessing the public markets, GMR just secured an infusion of $479 million in fresh capital.
Exactly.
That public market access provides a lifeline for their fleet spending.
It provides refinancing flexibility, and it frees up operating cash that can be directed toward investment in new vehicles, advanced aircraft, and ongoing maintenance.
So if you are a manufacturer like Ford or Textron, a well-funded, publicly traded client with access to capital markets is a far more reliable customer than a highly leveraged private company struggling to simply maintain its current fleet.
The suppliers win because their major customer just secured the funding needed to keep purchasing their products.
Okay, so the suppliers get a well-funded buyer, the banks collect their fees, and the private equity firms get their much-needed liquidity. But while those groups benefit from the transaction getting done, that lower valuation of $15 sets a rigid new standard in the market.
A very rigid standard.
And that standard immediately creates severe challenges for other companies waiting in the wings.
Yeah, the market established a new benchmark for valuation. If a company does not measure up to that benchmark, they are going to face intense downward pricing pressure.
The first group feeling that pressure is debt-heavy healthcare service companies. The data highlights names like Evolent Health, ticker EVH, and Acadia Healthcare, ticker ACHC. Why does the pricing of an ambulance company specifically hurt them?
Because investors are exhibiting extreme caution regarding leverage, and they do comparative math. The GMR listing demonstrated that sheer size and market share will not protect a valuation if the balance sheet is compromised.
Right? Investors are demanding cleaner balance sheets and highly visible cash flow across the entire healthcare services sector.
And as we established earlier, debt is the direct enemy of predictable cash flow. If a healthcare company carries a large debt load or if they face high labor costs, the market evaluates them through a much harsher lens today.
Yeah, high labor costs are a massive issue right now, considering the severe shortages in nursing and paramedic staffing.
Companies have to pay premium wages to retain talent, which eats directly into their margins. The discount applied to GMR will weigh heavily on the stock prices of peers who share those exact same financial vulnerabilities.
Investors look at a heavily indebted healthcare stock and say, well, if GMR is only worth this multiple, why should we pay a premium for you?
Right, you cannot hide behind top-line revenue numbers if your debt servicing and labor costs are consuming all your profits.
But the next group, negatively impacted, is where I get a little tripped up. The data points to private equity-backed IPO candidates and even recent listings across entirely different sectors. Names like Kava, ticker CAVA, and Birkenstock, ticker BIRK.
Yeah, I know, it sounds odd.
I look at companies like Kiavier, which operates Mediterranean restaurants, and BAK, which manufactures footwear. Why does the pricing of an ambulance company dictate how analysts value a restaurant chain or a shoe brand?
It seems completely disconnected on the surface. I mean, an ambulance has nothing to do with a bowl of hummus or a pair of sandals, but you have to look at the common denominator, which is the sponsor-backed label.
Meaning a private equity firm brought them to the public market.
Yes, exactly. The market is establishing a universal rule for private equity exits through valuation multiples. Analysts use multiples, like enterprise value to EBITDA to price companies. When a high-profile sponsor-backed IPO, like GMR prices, far below its original range, it recalibrates the expectations for every other new listing in the pipeline. Investors look at this transaction and conclude that if a top-tier firm like KKR had to accept a steep discount to take their company public, then every other private equity firm should have to offer a discount as well.
Oh, so the underlying product does not matter to the pricing algorithm. If a private equity firm is trying to sell an asset to the public demands a bargain.
That is the dynamic. Investors are willing to buy IPOs, but they are enforcing strict valuation discipline, they demand visible upside, and they want it priced in from day one.
Because they recognize that private equity firms have a massive backlog of companies they're desperate to sell.
Exactly. The buyers know the funds have time limits. That desperation gives the public market buyers the leverage to demand lower prices and lower multiples across all sectors.
Man, that is a tough environment for any company currently sitting in a private equity portfolio hoping for a premium public debut. It also impacts the final group we need to look at, which is the managed care and healthcare payers. We are talking about massive insurance companies like United Health, ticker UNH, and Humana, ticker HUM.
Right.
How do the insurance giants fit into the ambulance equation?
Well, emergency medical transport is a critical, unavoidable component of the wider healthcare cost chain. You have to view healthcare economics as a constant, ongoing negotiation between the providers who deliver the care and the payers who cover the bills.
Right. It is a finite pie of healthcare dollars.
Exactly. A tug of war between the hospital network or the ambulance company and the insurance provider. And every dollar the provider manages to extract is a dollar the payer does not get to keep.
So when a major player like GMR goes public, it shines a very bright spotlight on that specific intersection of the healthcare system.
Suddenly, their financials are visible to everyone. Analysts and investors become hyper-aware of the margin pressures facing both sides. If GMR has to squeeze out more margin to please their new public shareholders, they have to negotiate harder with United Health and Humana.
I see. So stronger provider economics, meaning the ambulance company increases its margins, inevitably pressure the payers, the insurance companies who have to absorb those higher transport costs.
Conversely, if the insurance companies tighten up their reimbursement policies, deny more claims, or lower their payout rates to protect their own profits, that puts immense pressure on the ambulance providers.
It is a delicate, highly contested balance.
Very. When investors focus heavily on ambulance pricing and reimbursement rates because of the GMR listing, that financial scrutiny travels directly up the chain to the payers.
Bringing this all together, the GMR IPO serves as a sobering reality check for the broader market. Deals can absolutely get done, and the capital is flowing. But the era of blindly paying top dollar for scale is over.
Right. Investors are prioritizing clean balance sheets, manageable debt profiles, and realistic, disciplined pricing over pure brand recognition.
It represents a return to strict mathematical analysis.
The market is functioning, but it is functioning with a much higher degree of skepticism. Buyers are looking past the marketing materials and doing their homework on the actual cash flow.
For you listening, this directly connects to how you build and evaluate your own strategy. When you are looking at new listings or assessing your current holdings in healthcare stocks, you must look closely at debt levels.
You have to evaluate cash flow predictability and understand the broader supply chain dynamics. You cannot just read the headlines about a company's total revenue and assume it is a safe place for your capital.
Exactly. You have to act like that cautious home buyer. You have to look past the fresh paint, check the plumbing, and make sure the foundation is solid. You must know who sits on the other side of their negotiating table.
Because if the foundational financials are flawed, the market will eventually force a discount, no matter how prominent the company's name or market share might be. The numbers always catch up.
Yeah, they do.
Uh,
And we want to leave you with a final thought to ponder that builds on everything we discussed today. We have seen clearly that private equity firms are realizing they must accept lower public market valuations to exit their older investments and return capital to their limited partners.
right.
So if we look down the road, how might this alter the types of private companies these firms choose to acquire in the very first place? If they know they can no longer rely on a premium-priced IPO to bail them out of a highly leveraged, debt-heavy acquisition, could this lead to a total reevaluation of what makes a company an attractive buyout target? It is something crucial to watch as you evaluate the next generation of corporate acquisitions.